Right now, while you are watching this video, millions of dollars are changing hands, not because a human made a decision, but because a machine did. Nearly 90% of all global trading volume today is driven by artificial intelligence systems, algorithms reacting to other algorithms in fractions of a second. And yet, the average person still loses to the market. Not because they are not smart enough, not because they do not have enough money, but because no one ever gave them a clear sequence to follow. That changes today. By the end of this video, you will have a 4-step roadmap, the exact same framework that financial educators have been teaching for decades, updated for the world we are living in right now. Whether you are starting with $50 or $50,000, whether you live in New York, Nairobi, or New Delhi, this roadmap works. Let us begin. Next, why this moment matters. Here is the truth about 2026 that most people are not talking about. The financial world has never moved faster. Markets open in one time zone and ripple across another before most people have had their morning coffee. News breaks, algorithms react, prices swing, and the average beginner watching all of this from the outside feels one thing: overwhelmed. That feeling is completely valid. But here is what that feeling costs you if you let it win. It costs you time. And in investing, time is the single most powerful force in existence. A person who invests a modest amount consistently starting at age 25 will almost always end up with more wealth than someone who invests 3 times as much starting at age 40. Not because they were smarter, not because they took bigger risks, simply because they started earlier and stayed consistent. The market will always feel complicated from the outside. Your job is not to master it. Your job is to follow the sequence. 4 steps, that is all. Let us walk through each one. Secure the foundation. Step 1 is the step most people want to skip. Do not skip it. Before you open a brokerage account, before you buy a single share of anything, you need to build what we will call your financial fortress. Investing is not for money you might need in the next 2 to 3 years. Full stop. Here is what building that fortress looks like. First, you need an emergency fund. This is a savings buffer that covers 3 to 6 months of your essential living expenses. Essential means rent or mortgage, food, utilities, transportation, the non-negotiables. This money lives in a savings account, not in the market. Its job is not to grow. Its job is to protect you. In a world where job transitions are happening faster than ever, and the cost of living continues to rise in most major cities globally, this buffer is not optional. It is foundational. Second, before you invest a single dollar, you need to eliminate your high-interest debt. And when we say high interest, we mean anything above roughly 8 to 10% annually, but especially credit card debt, which in many countries carries interest rates of 15, 20, even 25% per year. Here is the simple math that changes how people think about this. Paying off a credit card charging 20% interest is the equivalent of earning a guaranteed 20% return on your money. No stock, no index fund, no investment product can reliably deliver that on a risk-adjusted basis, so eliminating that debt first is not a sacrifice. It is the smartest investment you can make at that stage. Once your emergency fund is in place and your high-interest debt is gone, now you are ready. Your fortress is built. You have protected your downside. And from this position of stability, every dollar you invest from this point forward is money you genuinely do not need to touch for years. That is when investing starts working the way it is supposed to. Choose your tax and structure. Step 2 is where most beginners make a costly mistake, not by picking the wrong investment, but by picking the wrong account to put it in. Think of a tax-advantaged account as a wrapper. The investment inside can be the exact same fund, the exact same stock, but the wrapper around it determines how much of your growth the government takes, and when. Choosing the right wrapper before you invest is one of the highest leverage decisions you will make as a beginner. Let us walk through this by region. If you are in the United States, start with your employer-sponsored retirement account, most commonly called a 401(k). If your employer offers a matching contribution, meaning they match a percentage of what you put in, contribute at least enough to capture that full match before doing anything else. That match is an immediate, guaranteed 100% return on that portion of your money. Nothing in the market can compete with that. For 2026, the IRS has set the maximum annual contribution to a 401(a) at $24,500 for most employees. You do not need to contribute that much to start, but the more you can contribute, the more you benefit from the tax deferral. Next, consider a Roth IRA. A Roth IRA allows your money to grow completely tax-free. You contribute money that has already been taxed, and when you withdraw it in retirement, you pay nothing, not on the growth, not on the gains. The 2026 contribution limit for a Roth IRA is $7,500 annually. For younger earners especially, this account is extraordinarily powerful because of how many decades that tax-free compounding has to work. For our viewers outside the United States, the principle is identical, even if the account names are different. In Canada, look at the TFSA, the Tax-Free Savings Account, and the RRSP, the Registered Retirement Savings Plan. In the United Kingdom, the ISA, Individual Savings Account, serves a similar purpose. In Australia, superannuations accounts offer significant tax advantages for retirement savings. Most countries with developed financial systems offer some version of a tax-sheltered account. Research what is available in your country and use it before you ever open a standard taxable brokerage account. The order matters. Tax-advantaged first, taxable accounts second. This one decision, made correctly at the beginning, can mean tens of thousands of dollars in additional wealth over a 20 or 30-year period. Embrace passive indexing. Now we get to the question everyone actually wants answered first. What do you buy? For the vast majority of beginners, and honestly, for the vast majority of all investors, the answer there is index funds and ETFs, and here is why. When you buy a share of an individual company, you are making a bet that this specific company will grow, outperform its competitors, survive market cycles, and not be disrupted by technology or regulation. That is an enormous amount of uncertainty to place on a single entity. Even professional fund managers with entire research teams, access to company executives, and decades of experience, even they get this wrong more often than you would expect. Here is the data, and it is consistent across decades and markets. Over any 20-year window, index funds outperform more than 80% of actively managed funds. Not sometimes, consistently, across time, across markets, across different economic conditions. Why? Because index funds do not try to beat the market. They are the market. When you invest in a total market index fund or an S&P 500 index fund, you are buying a tiny ownership stake in hundreds or even thousands of companies simultaneously. You get instant diversification, broad exposure to economic growth, and you never have to guess which single company is going to win. And the cost advantage is staggering. Look for funds with expense ratios, that is the annual fee the fund charges, below 0.1%. For context, many actively managed funds charge 1 to 2% annually. On a portfolio worth $100,000, that difference compounds to a significant sum over decades. In 2026, the competition among fund providers has driven costs to extraordinary lows. Some funds, like certain offerings from Fidelity's index fund lineup, now charge $0 in annual fees. $0. Every cent of your return stays with you. For global investors, there are internationally focused index funds and ETFs that give you exposure to markets beyond your home country, reducing the risk of being concentrated in any single economy. A globally diversified portfolio of low-cost index funds is a genuinely world-class investment strategy, accessible to almost anyone with a brokerage account and a consistent habit. You do not need to pick winners. You just need to own the whole field. Automate and stay the course. Step 4 is where the strategy becomes real. And in many ways, it is the hardest step, not because it is complicated, but because it requires you to do something human beings are naturally bad at. It requires you to stay calm when everything around you is screaming that you should panic. The strategy is called dollar cost averaging. Here is how it works. You decide on a fixed amount, let us say $100 per month or $500 per month, whatever fits your situation, and you invest that amount on the same schedule every single month, regardless of what the market is doing, regardless of the headlines, regardless of how afraid you feel. Here is the elegant mathematics behind why this works. When the market is down and prices are lower, your fixed amount buys more shares. When the market is up and prices are higher, your fixed amount buys fewer shares. Over time, this naturally averages out your cost per share and removes the impossible burden of trying to time the market, of trying to buy at the exact bottom and sell at the exact top, which even professional traders cannot do consistently. The biggest threat to your investment success is not market volatility. It is your own behavior during market volatility. Every few years, markets will drop, sometimes dramatically. In those moments, the instinct is to sell, to stop the pain, to protect what is left. But history shows us, without exception, that markets have recovered from every single downturn. Everyone. The investors who stayed the course, who kept their automated contributions running, who did not sell in the panic, those are the investors who captured the full recovery. Modern brokers make this incredibly easy. Most platforms, whether you are using a major brokerage in the United States, Europe, Asia, or elsewhere, allow you to set up automatic recurring investments. You decide the amount, the frequency, and the fund, and then the system handles it. The human emotion is removed from the equation. The behavioral risk is neutralized. Set it up, then let it run. Let us bring this all together one final time. Step 1. Build your financial fortress, emergency fund, no high-interest debt. Step 2. Choose the right tax-advantaged wrapper before you invest a single dollar. Step 3. Invest in low-cost, diversified index funds and own the whole market rather than gambling on individuals' names. Step 4. Automate your contributions, stay the course, and give time the chance to do what it does best. That is the roadmap. 4 steps. Proven. Repeatable. Available to anyone willing to be consistent. Starting small is not a compromise. It is the path. The investor who starts with $50 a month at 22 will almost always outperform the investor who starts with $500 a month at 35. Because the most expensive mistake you can make is waiting for the perfect moment. A moment that never arrives. The market does not reward the smartest people. It rewards the most consistent ones. It rewards the people who built the foundation, chose the right structure, bought the whole market, and kept going when it was uncomfortable. That can be you. The roadmap is in your hands. Now follow it.